Good evening, and welcome to today's lecture on understanding tax deductions and adjustments to income. So, one of the things we're going to do off the bat is we're going to do a little bit of review. We're going to talk about important concepts. So, for the next few minutes, we're just going to go back and we're going to cover some things that we covered in previous lecture. So, as far as taxable income goes, just remember that taxable income is the portion of an individual's or business's income that's subject to taxation by the government. Taxable income includes most types and forms of wages, salaries, bonuses, business income, rental income, capital gains, dividends, etc., etc. For those of you who are interested and who are serious about understanding your tax return and how taxation works better, I encourage you to go back to your own Form 1040, your own personal tax return. If you want to see what your taxable income is, go to line 15 on the federal Form 1040. That line will reflect what your taxable income is. Now, for individuals, taxable income is calculated as gross income minus deductions, and that equals your taxable income. For businesses, it's a little different. Taxable income for businesses is the net earnings after subtracting all business expenses, deductions, and any allowable credits. Now, taxable income, keep in mind, taxable income is used to determine the amount of tax that's owed to the federal, state, or local government authorities. And that's based on the applicable tax brackets or corporate tax rates for that specific year. Okay. Now let's talk about adjusted gross income and let's define what that is. Adjusted gross income, some of you may know it to be called or referred to as AGI, is an individual's total gross income minus any specific adjustments that are allowed by the IRS. Now, the AGI serves as the starting point for actually calculating your taxable income and determining eligibility for certain tax deductions and other types of credits. The adjusted gross income is found on line 11 of Federal Form 1040. So, anyone who's interested in going back looking at your own tax return, you can refer to your Federal Form 1040. If you want to see what your AGI is, go to line 11. All right. Now, for individuals, gross income is calculated as gross income minus adjustments, and that equals AGI. All right. Next, the next concept we will talk about and explain a little bit more about is tax deductions. So these are the expenses that the taxpayer is allowed to subtract from their gross income in order to arrive at taxable income. So there's a differentiation between standard deductions and itemized deductions. For this specific lecture, what I want to do is to make sure that you know that these deductions are found on line 11 of Federal Form 1040. So if you want to see your standard deductions or your itemized deductions, go to line 12 on your Form 1040 and you will see, and it will also give you an indication of whether or not your tax preparer has prepared your taxes um, and used a standard deduction versus an itemized deduction. Okay. And the last concept we will cover in this section is adjustments to income. Now, us tax professionals and tax accountants, we consider that above the line deductions. Now, these specific, you know, adjustments include things like IRA contributions, student loan interest, etc. And they are subtracted from gross income to determine adjusted gross income. Adjustments to income can be found on Part 2 of Form 1040, Schedule 1. So if you have any of these types of adjustments to income, additional types of income are also found on Schedule 1. They are just in Part 1 of Schedule 1, but adjustments to income are on Part 2 of Federal Form 1040 Schedule 1. Okay? Next, we will talk about understanding tax deductions. What's important here is that tax deductions are expenses that are subtracted from taxable income to reduce your tax liability. Now, tax liability is simply the amount of tax that you owe or that you were supposed to pay. Okay. The standard deduction or and itemized deductions are just two of the ways that you can reduce taxable income when filing your tax return. Again, this specific amount is found on line 12 of the 1040. Now, standard deductions, um, we're going to talk about how standard deductions and itemized deductions differ. We're going to start with standard deductions. So, a standard deduction is a fixed amount that's set by the IRS that taxpayers can subtract from their income. Okay. That's the first point. The next point about standard deductions is that the amount varies based on filing status, whether you file your tax returns as single, married filing joint, head of household, married filing separate, or as a qualifying widower or spouse. And it's also important to know that it can also have some dependency on age, specifically as it relates to taxpayers who are 65 and older and or blind. Standard deductions do not require keeping track of your expenses. So it's straightforward and it's simple. It's a straightforward deduction. Nothing complicated about it. In 2024 or for 2024, which is the taxes that we are filing this year currently right now in 2025. For 2024, the standard deduction amounts are for single filers, 14,600, married filing joint, 29,200, head of household, 21,900. And for some taxpayers, they may find it beneficial to, you know, to do itemized deductions, but that specifically depends on that, taxpayer situation. Now, instead of taking a standard deduction, taxpayers can choose to deduct specific eligible expenses that they incur during the year. This is what we call itemized deductions. Some examples of common itemized deductions are mortgage interest expense. So you would receive a 1098 from your mortgage lender or your bank. Medical expenses. Now, medical expenses can be tricky because the only amount that's deductible would be the amount that exceeds 7.5% of your adjusted gross income. So there will be a calculation in figuring out what that amount would be and whether or not you are eligible to deduct any medical expenses. And that's a pretty high threshold for most taxpayers. Then there are state and local taxes that are paid. Now, there's a cap on state and local taxes of $10,000. You can certain itemized deductions also include charitable contributions. So those are contributions you make of cash to your churches or other nonprofit organizations. Those individuals or organizations would provide you with a written statement that contains the business EIN number, and they are usually on letterhead of the organization for instances or for your protection in case you are ever audited. You have documentation of those charitable contributions. Business expenses for self-employed individuals, those can also be calculated into your itemized deductions. And then there's also, while rare, I guess not so much these days with wildfires in California and South Carolina and North Carolina, but other itemized deductions can include casualty and theft losses. So that would be applicable in federally declared disaster areas. So if you have suffered or if there's ever any casualty or theft losses, and those some of those things may be deductible as well. So that's something good to keep in mind. When you choose to itemize your deductions, keep in mind that this requires good record keeping and receipts of all eligible expenses. So don't forget that. And also, keep in mind as well that choosing to itemize your deductions instead of using the federal standard deduction is only beneficial to you as a taxpayer if the total amount of your itemized deductions exceed your standard deductions. So I don't recommend, and I certainly do not opt to use itemized deductions for any of my clients unless those itemized deductions exceed the standard deduction. It's really just no point. It's a lot of work, and like attorneys or medical doctors or psychiatrists. We charge by the hour typically. So if you want to make sure that you keep your costs where they need to be, don't unnecessarily have your tax preparer search and hunt to see if to do the itemized deduction thing. It's just a lot of work and it could cost you additional money when you're getting your taxes prepared. So we'll move to the next item, which is understanding adjustments to income. And a lot of individual taxpayers really do not understand the whole concept of adjustments to income. So we're going to spend a bit of time talking about this, and hopefully it will make it a lot clearer for you to understand. Adjustments to income are specific expenses that taxpayers can deduct from their total gross income before calculating taxable income. So the adjustments actually lower your AGI, which then reduces tax liability and could also increase your eligibility for certain credits and deductions. Some of the examples of common adjustments to income would be things such as educator expenses. So the IRS does allow a $300 deduction per taxpayer for educator expenses. So if you file your taxes merit filing joint, that's a $600 deduction. So teachers and eligible educators can right off the bat, deduct this amount, for classroom expenses. Then there's student loan interest deduction. So any interest or that you have paid from making your student loan payments is also deductible. So this is an above the line item as well. IRA contributions. So if you contribute to a traditional IRA or any other type of IRA, it may be eligible, and deductible. It also depends on income and some other factors. So that's why it's also important to make sure that you ask questions and that you have the right conversations with whoever is preparing your taxes. And if you are preparing your taxes on your own, it's important that you understand the ins and outs of how this works as well. Health savings accounts, we call those HSAs. Any contributions to HSAs may be deducted if the taxpayer has a high deductible health plan. There's also self-employed retirement plans, SEP plans, other simple IRA, type of plans are also deductible. The self-employment tax deduction. Self-employed individuals can deduct 50% of their self-employment tax. So if you are self-employed, when you look at your tax return, it will show you what your self-employment tax is. Well, 50% of that tax is deductible. So you can deduct that. And it is an above the line adjustment. Alimony paid. Now, the alimony thing is specific, and it's specific to divorce agreements before 2019. So any alimony payments made, under any type of pre-2019 divorce agreements are deductible. Anything, past 2019, no. Moving expenses for military members. Certain moving expenses are deductible as well. You have to be careful, because in many instances the military will move you. We've already always had military moves when my husband was active duty. So we couldn't deduct any expenses for that, but certain things we could. So, again, speak with your tax preparer or your tax accountant. Make sure you understand, if you are military, what is deductible and what is not. Tuition and fee deductions, that those would be things that are identified on a 1098-T, which is for tuition and education expenses. So certain higher education expenses are deductible whenever it's applicable. Now, one of the tricky things with education expenses that a lot of people don't understand, there are two boxes that you need to pay specific attention to on the 1098-T. That's box 1 and box 5. And in summary, to make this short, if your box 5 number exceeds your box 1 number, it's not deductible. If your box 1 number, if the number that's in box 1 of that 1098-T exceeds box 5, the difference of that is deductible. I don't want to get too far in the weeds because I don't want to confuse you, but maybe in a later lecture or in another topic, or you know, um, we can discuss that a bit more, but I don't want to confuse you. But again, pay attention to two boxes on 1098-T. That's box 1 and box 5. Penalties for early withdrawal from savings. So if you withdraw funds early from a CD, certificate of deposit, or similar account, and you get penalized, if you itemize your deductions, that penalty is deductible. Now, why adjustments to income matter? Three things that you should be aware of. One, they lower your taxable income and it reduces your overall tax burden or tax liability. The second thing is, a lower AGI may make a taxpayer eligible for more tax credits and deductions. So be mindful of that. And lastly, unlike itemized deductions, adjustments to income can be claimed even if you use the standard deduction. So there's a difference there. And that's a key thing to remember. Those above the line adjustments, it doesn't matter whether you use the standard deduction or you itemize your deductions. Um, and lastly, just in a quick comparison, when we compare adjustments to income versus deductions. So to recap, adjustments to income reduce adjusted gross income, or AGI, which affects your eligibility for certain credits and other deductions. And then deductions can be standard or itemized. They reduce your taxable income, and which lowers your overall taxes owed. So in comparison, if we were to look at an educator expense, and we're doing this by category. So if it's an educator expense, is that an adjustment to income or is that a tax deduction? It's important for you to know and understand the difference. So an educator expense will be an adjustment to income. If it's student loan interest, is that an adjustment to income or is that a tax deduction? As we've covered in our material for tonight, student loan interest is an adjustment to income. Mortgage interest. So if you pay mortgage interest on your tax return, is that an adjustment to income or is that a tax deduction? Mortgage interest would be a tax deduction, and mortgage interest would be deductible if you are itemizing your deduction. If you're using a standard deduction, mortgage interest cannot be claimed. And the last one we'll talk about is medical expenses. So, are medical expenses adjustments to income or are medical expenses tax deduction? Medical expenses are a tax deduction. Medical expenses have a cap, so you can only deduct the amount that exceeds 7.5% of your AGI. So just remember that threshold. So that's all we have for tonight's lecture on the subject of understanding tax deductions and adjustments to income. I hope you find this helpful, and I hope that you take the time to refer back to your own personal 1040 and get a better understanding or get a better knowledge and understanding of the ins and outs of what goes on your personal tax return so that you can have an educated discussion with your tax preparer and so that you will understand the numbers that flow through your tax return. Remember, as a taxpayer, the onus of whether or not your tax return is correct or not is on you. It's on the taxpayer, not the tax preparer. All right. There is a certain level of professional responsibility that, as tax professionals, that we are, subject to. However, it's important that you understand what is being reported on your individual tax return. In the chat of this video, I have posted the reference links to the IRS so that if you would like to gain better knowledge and understanding of what the IRS specific details are, you can reference those two website links. One will take you to the irs.gov, credits and deductions for individuals, and the other link will take you to the definitions of adjusted gross income, and it will also provide you with specific examples that I've covered in tonight's lecture about what adjustments to income is, and it will also provide you with a link to Schedule 1 of Federal Form 1040, where you can see all of the lists of, in Part 1, it will be additional income, and in Part 2 of Schedule 1, it will provide you with the different specific types of adjustments to income. I hope you found this lesson helpful, and if you have any questions or comments, it would be great if you would post those. I'm going to post this video on YouTube so that you can reference back to it at your leisure. I hope you all have a great evening, and I will see you all next week. Good night.